So yeah, where to invest your money? I mean, that's a question pretty much everyone asks, right?
Absolutely. It doesn't matter if you're just starting out or you've been saving for ages, it always comes up.
It really does. It feels pretty fundamental to, managing your finances.
Definitely. And it's not just about putting money aside, it's about making that money work for you strategically, helping you reach those financial goals.
Right. So for this deep dive, we've sifted through quite a bit of information, trying to nail down some, let's say, smart strategies.
Hmm.
Our mission, really, is to pull out actionable stuff, things that can help you build wealth, feel a bit more secure, without making it overly complicated or full of jargon.
Yeah. And the sources we looked at covered a really wide range, didn't they?
They did.
We're talking traditional things, stock market, real estate, but also newer things, digital gold, crypto,
And even investing in yourself, which I found interesting, personal development as an investment.
that too. Lots to cover.
Okay, let's get into it then. It seems like before we even talk about growth, there's a step one, a foundation.
Yes, exactly. That came up again and again. The absolute first thing is building an emergency fund.
The safety net.
Precisely. It's your cushion. For when life throws you a curveball, unexpected costs.
Makes sense. And how big does this cushion need to be? What's the general advice?
Typically, the recommendation is 3 to 6 months worth of your essential living expenses.
3 to 6 months. Okay.
Yeah. So if you lose your job or have a medical bill, you're not forced to suddenly sell your investments, which might mean selling at a loss, right?
Right. You avoid that panic sell. So where do you keep this emergency cash? Not just your regular bank account.
Ideally, no. You want it somewhere safe, but also easy to access quickly. So think like a liquid mutual fund, maybe, or a high yield savings account.
Liquid fund, high yield savings. Okay.
The main thing is accessibility and safety. You're not really trying to make big returns on this money.
Got it. Okay, safety net established. Let's talk growth. The stock market usually comes to mind first for many people.
It does, yeah. And historically, it's shown really significant potential for long-term wealth building.
How does that work fundamentally?
Well, by buying shares, stocks, you're essentially buying a tiny piece of a company. So if the company does well, grows, your investment potentially grows too, either through individual stocks or diversified funds.
And getting started seems easier now. The sources mention specific platforms.
Oh, much easier. Platforms like Zerodha, Grow, Robinhood over in the US, they've really democratized it. User-friendly apps, lower fees, it opens it up.
So if you're just dipping your toes in, where's a sensible place to start?
Picking stocks feels daunting.
It can be. The material often suggests focusing on blue chip stocks first.
Blue chips, meaning.
Shares in big, established, financially solid companies. Less volatile, usually. Or another really common starting point is index funds.
Ah, like the Nifty 50 or S&P 500. Exactly. Those funds track a whole bunch of leading companies, so you get instant diversification. It's generally seen as a more stable entry point than trying to pick winning individual stocks right away.
Okay, stocks make sense for that long-term growth picture. What about mutual funds? Heard a lot about those too.
Yes, mutual funds are super popular, especially maybe for beginners or people who are okay with some risk, but not, extreme risk. Moderate risk tolerance.
And how do they work?
Basically, they pool money from lots of investors. Then a professional fund manager takes that pool and invests it across different things, stocks, bonds, maybe a mix.
So diversification and someone else managing it.
That's the core appeal. You get both. And there are different types, right? Equity funds for stocks, debt funds for bonds, hybrid for a mix. Depends on your goals and risk appetite.
And the sources also mentioned SIPs, systematic investment plans.
Ah, yes. SIPs are a big feature.
Those involve investing smaller amounts regularly.
Exactly. You commit to investing a fixed amount, say, every month into the fund you've chosen.
And the advantage there is
It's a strategy called rupee cost averaging or dollar cost averaging elsewhere. When the market's down, your fixed amount buys more units. When it's up, it buys fewer.
okay.
Over time, it smooths out the bumps, helps take the guesswork and emotion out of trying to time the market.
That does sound less stressful. Okay, shifting gears a bit. Real estate, the classic tangible asset.
Yes, bricks and mortar. Traditionally seen as very secure, it offers potential in two main ways, really.
Which are?
One is capital appreciation, the value of the property going up over the long term. The other is passive income if you rent it out, rental yields.
So asset building and potentially income.
Hmm?
But it takes a lot of money to get started, usually.
It certainly does. That's the main barrier for many. Significant upfront capital needed. Plus, it's not passive in the sense of do nothing.
Right. There's ongoing stuff.
Property taxes, maintenance, finding and managing tenants if you rent. It requires effort and ongoing expense.
The source is flagged checking for upcoming infrastructure. Why is that important?
Good point. If you invest in an area where, say, a new metro line or highway is planned, that development can really boost property values down the line. Better connectivity, more amenities often follow, potentially a better ROI.
Research is key there then. Okay, moving to something India-specific mentioned. PPF, Public Provident Fund.
Yes, the PTF. It's a very popular long-term savings option in India. Very safe, government-backed.
And the big draw seems to be the tax benefits.
Huge draw. The interest earned is completely tax-free, and the returns are guaranteed, which is rare.
Tax-free interest, guaranteed returns. Sounds great. What's the catch or the main thing to know?
The main thing is the lock-in period. It's 15 years, so it's really designed for long-term goals. Think retirement planning.
15 years. Okay, definitely long-term.
And there's a limit on how much you can put in each year, currently up to 1.5 lakh rupees. That contribution also gets you a tax deduction under Section 80C.
So it's ease status, exempt, exempt, exempt.
That's the term, yes. Contribution exempt, interest exempt, maturity amount exempt. Very tax efficient, especially with that guaranteed return in potentially shaky markets.
Powerful tool for long-term, safe growth. Now, maybe the most traditional of all, fixed deposits, FDs.
FDs. Yes, generations have used these. They are definitely one of the safest, lowest risk options out there.
How do they work? Simply.
You put a lump sum in the bank for a fixed period, could be months, could be years, at an interest rate they tell you upfront. Predictable.
So ideal for someone who really hates risk.
Exactly. If your priority is protecting your capital, knowing exactly what return you'll get, FDs are strong.
Like the downside is usually lower returns.
Generally, yes. The interest rates on FDs are often lower than what you might get from, say, equities over the long run, and sometimes they might not even beat inflation.
So your money's safe, but its buying power might erode slightly.
That's the trade-off. The sources suggest shopping around, comparing rates between banks, and looking into specific tax-saving FDs if that's relevant for you.
Okay. Let's talk about gold. Always seen as valuable. How does it fit in today?
Gold still holds that safe haven status. Especially when the economy looks uncertain or inflation is high, people turn to it.
As a store of value.
Exactly. It's seen as preserving wealth. And it adds diversification to a portfolio because its price doesn't always move in line with stocks or bonds.
But you don't need actual gold bars anymore, right?
No, not necessarily. Investing in digital gold or gold ETFs, exchange traded funds, is much more common now. It's convenient, liquid, you don't have storage hassles.
And how much gold should someone consider holding? Any rule of thumb?
The suggestion often is around 5% to 10% of your total portfolio. Enough to act as a hedge against market swings, but not so much that it drags down overall growth potential if gold prices are flat.
Bit of ballast for the ship then. Okay, now for the really exciting, potentially scary one. Cryptocurrency.
Chuckles, yes. Crypto, Bitcoin, Ethereum, all the others. It's definitely a newer asset class and, yeah, highly volatile.
Potential for big gains, but also big losses.
That's the story. Huge potential returns, but matched with equally significant risk. Prices can swing wildly, unpredictably.
And the sources really hammered home the need for caution here.
Absolutely. Regulation is still patchy in many places. It's complex technology. You really need to understand what you're buying into and the risks involved.
So the advice is?
Pretty consistent. Only invest money you can truly afford to lose. Like, if it went to zero tomorrow, you'd be okay. And you secure digital wallets, stick to reputable exchanges, do your homework.
High risk, high reward. Definitely not for everyone or for essential savings. Okay. Now, that other investment type we mentioned earlier, investing in yourself.
Ah, yes. Education skills. This might actually be the smartest investment anyone can make over the long run.
How so?
Because boosting your skills, your knowledge, it directly increases your earning power, your value in the job market.
Makes sense.
Learning a new language, getting good at coding, understanding digital marketing, earning professional certifications. The potential return on that investment over a career can be massive.
Yeah.
Far more than many financial assets.
And there are accessible ways to do this now.
Oh, absolutely. Platforms like Coursera, Udemy, LinkedIn Learning, they offer tons of courses, some free, some paid, covering almost anything you can think of.
So really investing in your human capital.
Precisely. The ROI can be phenomenal and lasts a lifetime.
Okay, wow, we've covered a lot of ground. Stocks, funds, property, PPF, FDs, gold, crypto, skills. Are there some core principles that tie all this together, a kind of underlying philosophy?
Yeah, definitely some key themes emerged.
Hmm.
First and foremost, there is no single best investment, no one-size-fits-all answer.
Too personal.
Extremely personal. Your ideal strategy depends entirely on your specific financial goals, your comfort level with your risk appetite, and your time horizon. How long are you investing for?
Right. Someone saving for a house deposit in 5 years needs a different approach than someone saving for retirement in 30 years.
Exactly. Huge difference. Another core principle is diversification. Don't put all your eggs in one basket.
Spread the risk.
Spread the risk across different types of assets. Stocks, maybe some bonds, maybe a bit of gold, maybe real estate if appropriate. That mix helps cushion the blows if one area performs poorly.
And starting small is okay.
Absolutely. The sources emphasize starting small and just being consistent. You don't need a fortune to begin. Regular contributions, even small ones, add up dramatically over time thanks to compounding.
Compounding. The eighth wonder of the world, supposedly, where your returns start earning their own returns.
That's the magic, yes. It's like a snowball rolling downhill. And the key ingredient for compounding is time.
So starting early is a big advantage.
Massive advantage. The longer your money has to compound, the more significant the growth potential. Time is your friend in investing.
Okay. And wasn't there a pro tip mentioned frequently?
Yes, there was. A really practical one.
Let's hear it.
Review your strategy regularly. Don't just set it and forget it forever. Check in every, say, 6 to 12 months.
Fine.
Because your life changes. Your goals might shift, your income might change, your risk tolerance could evolve. You need to make sure your investments still line up with where you are now and where you want to go.
That makes total sense.
Yeah.
It's not static. Investing is an ongoing process.
Exactly. It needs to adapt as you do.
Okay, so summing up, it feels like the main takeaway isn't about finding one perfect investment, but more about building a thoughtful, balanced plan that fits you,
That's it, exactly.
understanding the different options, their risks, their potential, and then being consistent and patient over the long term.
Couldn't have said it better. Aligning your investments with your personal situation and actively managing that journey over time.
Well, this has been incredibly helpful, a really great deep dive. It does leave me thinking, and maybe leaves our listeners thinking too. Consider that idea of risk. We talk about it a lot. High risk, low risk, moderate risk.
Right.
How does your personal definition of risk tolerance maybe look right now? And how might that change as you learn more, as your circumstances change? And maybe, just maybe, which of these avenues we discussed actually sparks your curiosity the most? What might be your next small step to explore that one a little further?
That's a great reflective question to end on. Food for thought.